Good morning, everyone, and welcome. We are all together today, stakeholders from the US and 11 other countries, Belgium, Bermuda, Canada, Chinese Taipei, Finland, France, Germany, Japan, Netherlands, Switzerland, and the United Kingdom, and many IAIS members, including many members of EXCO, are around today. So it's a great opportunity to engage together as part of a stakeholder engagement, which, as you know, we have prioritized under my chairmanship through the Stakeholder Engagement Task Force. In terms of my IAIS colleagues, there are too many to name without sort of eating up too much of the time that are around. But I want to flag that the leaders of the Financial Stability and Technical Committee, that is all responsible for developing ComFrame, and within that the ICS, are here with me. Elise Liebers, who is acting chair of the FSTC and acting up now that Mike McGrath has resigned, and Urs Halbeisen, who is the co-chair of the FSTC. And they're going to be leading the second and third session, respectively. Happy New Year. 2016 was clearly a memorable year, an inflection point. I think it's going to come to be seen globally. Not only, obviously, because of the geopolitical developments in my own jurisdiction, in this country, and other developments that are of less relevance to IAIS, but that were equally memorable, such as the demise of David Bowie, Leonard Cohen, and during Christmas, George Michael. So very much a memorable year that we will come to recall its consequences. I'm sure 2017 will bring additional developments. There are further developments ahead. And I'm not sure about George Michael, Leonard Cohen, and David Bowie, but obviously the broader geopolitical environment does shape the IAIS's activities, and we do take that into account in our strategic discussions and developments. It would be amiss of me not to thank our hosts of the NASC. Yoshi has already done it on behalf of the Secretariat for inviting us into this wonderful place. It's so good. Winter is biting hard in Europe and other parts of the world, and it's delightful to be in this beautiful part of the world. So, now, as you know, as you may know, we've just spent a day and a half because this is our first meeting of the year. It's a retreat discussing issues, more strategic issues about our work plan and our direction. The issues that were covered included further improvements to the GSI assessment methodology, to our direction of travel with respect to the activities-based approach, what is our overall timetable and milestones in relation to that. We also, that's on one end of the spectrum, affecting GSIs that are of interest, obviously, to our developed country members. And then at the other end of the spectrum, we had important discussions on the association's strategy in supporting emerging market supervision and standard setting. Today's agenda is, of course, on the ICS, and we did spend some time discussing the ICS. let me repeat that ICS is one element, it's a very important element, but it's one element of ComFrame. ComFrame includes all the other very important qualitative elements, and ICS as a quantitative standard is one element of it. So in terms of ICS, I can tell you that we reviewed the timelines for the ICS project, and we agreed to maintain the target date of 2017 for version 1.0 and 2019 for version 2.0. ICS version 2.0 is intended for implementation by supervisors, and there is an expectation of supervisory consequences for internationally active insurance groups that do not meet the ICS requirements once the ICS has been implemented by jurisdictions. As we prepare the 2019 version 2 of ICS, we reinforced our commitment to extend field testing to all likely IAIGs and other interested firms. We will also clarify what is expected from IAIGs and the supervisors during the period of annual field testing from 2017 to 2019. Confidential reporting of version 1.0 was originally intended as an expansion of the annual field testing process through which a broader group of volunteers would be encouraged to provide confidential ICS data and calculations on a narrow set of options than the full field testing process. So this was, when we talk about ICS version 1.0 implementation, because this is, I'm sure it's clear to some of you, but it has not always been entirely clear to everyone. That's what we meant. We meant a narrowing down of the options we are field testing and an expectation that supervisors will require in the domestic jurisdictions all their IIGs, home supervisors, to report under ICS version 1.0, to do the calculations. So in that sense, what we used to call confidential reporting is extended field testing to all the sample of firms to which ICS version 2.0 will be applied on a narrow set of options. So that's the meaning of implementation of ICS version 1.0. So, but we recognized that there was lack of clarity, including at times even within our own membership. Accordingly, we will now clarify the process that we will follow agreement of version 1.0 by describing it as an extended field testing of version 1.0. But the overall timelines for the ICS project are not changing, and I want to stress that all members, there was consensus of that, consensus amongst our EXCO members, reinforce the commitment to deliver ICS version 2.0, which will be the version that has always been intended to have supervisory consequences within the agreed timeline. So in terms of what to expect and buy, by when, I will leave the details to my colleagues, but we can have these discussions as well. Again, the timetables have not changed in terms of expectations. Let me stress that it is really important for volunteers to stay engaged in the ICS project. If other insurers want to participate, we encourage them to become volunteers and to begin discussions with the supervisors as soon as possible. As I said, implementation of ICS version 1.0 means that all IIGs will be will be requested by the supervisors to participate, but everyone else is welcome to be field tested. There's no expectation, supervisor expectation that there would be, but everyone else could speak to the supervisor and participate as well. I've already discussed the plan for today, with that, let me stop here, and I look forward to hearing your views. I'll be here until lunchtime, and I look forward to a very interactive and collaborative discussion. Thank you for your engagement and for coming here.
We'd now like to invite the first of the presentations from stakeholders. We have a few chairs at the front of the table there, so we would invite Dennis Nortok from Geneva Association and George Brady from the IAF to do the first two presentations, please.
Good morning, everyone. My name is Dennis, and I work for the Geneva Association. I wanted to thank the IAIS for giving us the opportunity to speak here and to provide an overview and a summary of the key messages from our response letter to the ICS consultation. Could you go to the next slide, please? In our response letter, we acknowledge that good progress has been made on a range of technical issues. As we all know, the consultation focused on valuation, capital resources, and calibration. But we also found that there are a number of issues that have not been dealt with. And in our response, we mainly focus on these issues. One of the issues, amongst others, is that we think that further work is needed to explain the ICS in relation to existing capital regimes. As placing the ICS on top of existing regimes will result in conflicting solvency regimes. We also highlighted that it is critical to its success that the ICS project gets the necessary political buy-in at all levels along its development. We felt that the extent to which the ICS gets clear political commitment from national regulators is unclear, not least due to development towards national regimes. Now, before ICS version 1.0 is released, we think that further work must be done, amongst others, to explain the ICS relation to existing capital regimes, as we believe that the ICS cannot work in isolation. We also think that the interplay of the ICS and other modules and elements of ComFrame need to be clarified. As that was mentioned before, there are also qualitative elements, part of ComFrame, that are very important. And paying due attention to that could reduce the weight attached to hard capital requirements. We also indicated that substantial improvements need to be made to valuation approaches, but George will talk to that, about that in a minute. Let me see. All right, I won't read out all of these messages here, but there are a couple of messages I would like to highlight. One of them is the third point. In its current form, the ICS has a very prescriptive nature. We think that it goes beyond and above the level of prescriptiveness for it to be a basis to achieve real comparability of solvency requirements and positions, and seems to diverge from the principles-based approach the IAIS seems to take with other parts of ComFrame. So we, as mentioned before, think that ICS needs to be truly embedded in ComFrame, and capital is viewed as a part of a broader supervisory framework, including other elements like ERM standards, ORSA, and stress testing. Another point here is a second last point. We mentioned that the ICS need to be based on a valuation framework that takes due account of the insurance business model. In these slides, we have not detailed our position on this issue, which approach to use for discounting, but it was a key element of our response, and George will, I think, talk about that in a bit more detail. However, the approach taken to discounting is a very important topic, and perhaps even the most important one, and must address the cyclicality issues, and further work is required. In our response, we have highlighted that the valuation framework must be tailored to the insurance business model and the long-term investment horizon of life insurers, recognizing buy and hold strategies. We think that the current options as presented in the IAIS consultation document must be supplemented. There should not just be one approach, but more approaches must be tested. Going forward, valuation approaches must be flexible and be able to reflect a wide range of insurance products across jurisdictions. An overwhelming majority of members believe, or members of the GA and the IIF, believe short-term volatility is excessive in relation to the long-term nature of, amongst others, life insurers. Therefore, there is a need to address this. In our response, we highlighted that the overwhelming majority of our members, including all the GSIIs, believe that current approaches to dampen volatility do not address the issue and think that significant further work is required. In particular, they stress that an option that should be seriously considered and explored further is an expected earned rate with proper guardrails, in addition to other options to be tested, such as a reference portfolio. A few member companies remain committed to having the option to use an unadjusted discount curve for liabilities. In November, an approach called the own asset with guardrail was presented by some large insurers at the IAIS stakeholder meeting. We urge the IAIS to test this and stand ready to develop the approach further. It is consistent with the insurance business model, incentivizes good risk management, and does not result in pro-cyclicality. Others prefer to address excessive short-term volatility through a reference portfolio, which should also be tested. We sincerely urge that further options are tested in the field test, and we stand ready to work with the IAIS on this. Now, the last slide of my part of the presentation. There are a couple of messages I would like to highlight here, but in the interest of time, I will keep this short. We found there's a redundant layer of conservatism with regard to MOCHI and no letter of intervention, and we think that that needs to be considered. Another issue that we would like to highlight is that in general the ICS framework must pay due attention to the insurers' business models. And I would just now hand over to George.
Thanks, Dennis, and thank you, Chair, and members of the IAIS for the opportunity to speak today. First order of business, how do I get my slides? Do I control that from here? While we get there, I will just say that while I'm presenting now on our own behalf, my remarks will build on the comments presented by Dennis from the Geneva Association. But we did develop a joint response to the ICS consultation and submitted that letter in October. So what we intend to do today is present those views to stimulate discussion with you here today and in the months ahead. Perfect, John. Although at the IIF and GA we don't have a balance sheet to test and aren't directly involved in the field testing process, because of our membership representing the vast majority of globally active firms and our mission to provide global perspectives, together with the Geneva Association, we're able to provide a somewhat unique set of perspectives into the IAIS work. So our aim in working with global policymakers, like the IAIS, is to work toward the range of our shared objectives, reflected in the IAIS mission statement of promoting effective and globally consistent supervision of the insurance industry. Should everybody speak at the same time? Should we all join in order to develop and maintain fair, safe, and stable insurance markets for the benefit and protection of policyholders, pause, and to contribute to financial stability. If we were to add to this iteration of purpose, we would perhaps be specific about ways in which our industry contributes to global economic growth and stability in carrying out our role as institutional investors, ways in which our long-term investment horizons have served to dampen economic shocks, and ways in which our industry has proven resilient through troubled times, thus remaining available to transfer risks off the balance sheets and out of the households of our policyholders. And before I want to get into my remarks, I also want to express our strong support for the IAIS efforts to establish a clear plan on stakeholder engagement, and we'll be submitting comments on the draft plan later this week. But this stakeholder meeting is an example of an important opportunity for market participants to learn about the work of the IAIS and your highest level strategic thinking at this time of year, and to provide our feedback and engage in important discussion on the key issues of the day. But needless to say, it's critical for this to happen that IAIS members demonstrate the interest and commitment to making this a meaningful exchange. And the presence of those of us here today is testament to that commitment. Are we this way? No. Are we that way? How about there? So I'll address these three issues in my remarks, again, supporting Dennis's comments, but focusing in the end on the issues around valuation. To start off, much of this was covered by Dennis earlier, but critical to this point are three things. First, the IAIS has to be clear how the ICS fits into ComFrame. So much has been done in the last 2 or 3 years on ICS, and in contrast, relatively little on the rest of ComFrame. Second, how the ICS interacts with existing capital regimes is critical to understanding the added value of the ICS. And we are hopeful that these continuing discussions add additional clarity to this. It has to be adaptable to different environments. And third, perhaps most importantly, to justify the continuing expenditure of time and money by the industry and by regulators, the nature and extent of members' commitment to incorporating the ICS and ComFrame into their regulatory and supervisory way of life must be transparent and well understood. This doesn't mean that members must express a singular intent to adopt and implement ComFrame, including an ICS, unadjusted. It means that whatever supervisors' plans are for utilizing the outcome of this extensive project needs to be fully discussed, debated, and agreed. There are too many statements and actions and signals from members in recent months, and too many jurisdictions modifying or modernizing or evolving their domestic regimes for this question to remain unaddressed. As a way forward, we continue to urge the IAIS to reassess its timeline and how its definition of success, embodied in the ultimate goal, relates to the extensive technical work being done. This may require taking more time and adjusting expectations, and you may find, for example, that you have to revisit the timing and expectations associated with your work on things like the HLA. We urge the IAIS to return attention to the underlying principles and regulatory objectives of this work, to pursue a progressive evolutionary process based on these principles, and to test this thoroughly, and to evaluate the results of the testing, and to repeat as necessary. And in the testing process, continue to evaluate the results against the principles and regulatory objectives to remain true to the mission and avoid an overly prescriptive result. This approach and commitment to getting the right answer from a robust process must supersede any adherence to an arbitrary end date for this work. And you may find that in doing so, you produce a framework that's inclusive of different regimes and different approaches that meet your basic objectives. So in doing so, we urge you to be true to the intentions stated within ComFrame, Module 2, Element 5, for the ICS to function as a basis for comparability of IEAG regulation and supervisor processes. So continuing from the previous slide, we feel it's critical to the success of ComFrame to consider the ICS fully in the context of the range of qualitative supervisory tools that the chair alluded to earlier and practices contained within the mothership of ComFrame. I understand we'll hear later today about how ComFrame is being interwoven into the ICPs, and hopefully as well the handling of expectations on adoption, and subsequent monitoring and testing of implementation, and any subsequent maintenance of this intricate regime. And within ComFrame, we urge you to leverage one of your unique strengths, your extensive, committed membership of supervisors, to ensure that you're doing all you can to maximize the supervisory colleges in the process of supervisory cooperation. Focus on enhancing the frequency and the value of the exchanges. Fight against a tick-the-box approach to supervision. Spend the necessary energy educating and empowering your members to educate themselves and their colleagues on the companies and groups they supervise. This may require expanding the colleges to incorporate more extensive interaction with senior company management. In the end, both supervisors and firms benefit from supervisors' deep understanding of the firms they supervise. And this requires the right supervisors spending enough time with the right firm officials. To support this, we strongly recommend you to draw on the experience of your frontline supervisors in the supervisory forum, for example, and use this experience to help identify the gaps in current supervisory practices. And now the issue of valuation, which of course is one of the key issues that will be presented to the FSTC to consider and involves how you build your valuation approaches to achieve stable and comparable outcomes. Although not nearly as labor and cost intensive as the work done in field testing itself, both Dennis's organization and ours spend considerable effort among our members in responding to the ICS consultation, evaluating the state of play regarding, among many other issues, the fundamental issue of an appropriate valuation approach for insurance liabilities. And we considered in our work the purposes and values to be pursued in this endeavor to improve consistency, work toward bridging the gap between different valuation approaches currently proposed in the ICS, to reflect and incentivize prudent asset liability management at the heart of insurance risk management, and avoid procyclicality. In our letter, we presented several views that members supported, and some have already been considered in field testing. Another approach that Dennis referred to based on an expected earned rate, the own assets with guardrails approach, was presented by those companies on an earlier IAIS stakeholder call. And as I understand it, work continues at these firms as they take into consideration the necessity to avoid creating adverse investment incentives and fill out the notion of what constitute effective guardrails. The majority of our members believe the ICS valuation approach should address the problem of excessive short-term volatility and recognize the ability of insurers to apply a buy and hold investment strategy as part of their asset liability management. Others prefer a reference portfolio, while a few remain committed to the use of unadjusted discount curves for liabilities. But in the end, our fundamental position is twofold. Don't close out the range of options being considered, and ensure that the field testing results are meaningful to evaluate. Don't start the process of blending different facets of different approaches into composite options. So we have crafted started to call this advocating a primary color approach. So sticking to a few pure, if you will, approaches as you evaluate your different options. And then later, when the results are available, do the analysis of how these approaches play out, and then and only then consider how to adjust one or more to achieve your regulatory objectives. Final comment. This process aims to produce a measure that's not only effective, but more importantly appropriate to the insurance business model and to function in an extremely wide range of jurisdictions and on a wide range of insurance products in an increasingly dynamic economic, financial, and political world. It not only will, but it should take a considerable amount of time. Look at how long it took the Basel Committee to develop its framework, and Europe with Solvency II. As you produce the results in this process, consider carefully the signaling to the market that results from suggesting that you've achieved a first version of the ICS, and have an outcome that's ready for confidential reporting, when all indications are that the ICS will continue to be built and refined. Again, thank you for the opportunity to present here today, and happy to engage in further discussion of these important issues.
Thanks very much, George and Dennis. Our plan was to have the final presentation for this session from Dave Sandberg of the International Actuarial Association, and then open to questions from members to the three of you, just from a time management point of view. So if you two wouldn't mind just staying there until I think Dave has a small number of slides, which I'll go and find now.
Well, John's bringing up those slides. I want to thank you for the opportunity to present. We're very appreciative of the extended comment period that was allowed for the International Capital Standard. It allowed us to leverage the unique resources that the IAA can bring. We were able to bring in experts on health, mortality, property and casualty, experts on accounting that have been working with these issues for quite some time, to be able to provide feedback into the questions that were raised. Let's see. There we go. So, at a high level, we're very supportive of the efforts of the IAIS, and we appreciate the effort to be actively engaged in this framework. Because of our diverse membership, we're able to bring in both regulators from Europe, North America, Asia. We're able to bring in actuaries that work as consultants, that work with large organizations such as GSIs, IAGs, and smaller size companies as well. So we're not missing viewpoints and issues that need to be resolved, and allows us a chance to challenge each other and work through and say, yeah, there's always some issue or concern, but are there workable solutions? And so we've been very supportive of the direction, and we agree with this goal of achieving some way of creating a better dialogue and comparability across worldwide supervisory frameworks. Let's see. For quite some time, the IAA has been supportive of the idea of looking at a total balance sheet approach, the idea of shocking, putting in stresses, using a confidence level as a basis for starting a conversation. So the overall framework and design is one that we've been encouraging and are glad to see being carried out in the conversations here. We do think there's important considerations that need to be thought through, and we want to kind of highlight those, not as issues that say this shouldn't be done, but as just things that we think are possible to do and can be done with additional thought and conversation. One thing that's probably important to realize first up front is that the idea of a confidence level is not a precise number, and it's often misinterpreted. There's much less precision in the actual number, and so one of the important things is to make sure we understand what is the level of imprecision that's there. Obviously, we're going to make some simplifications to get some comparabilities, but are we talking about small issues, or are there large issues and variation where we're really just guessing at a number? And let's make sure we understand that and the implications, especially when we add that to the idea of a group. And how do we think about diversification within a group? The risk dependencies and the ways those interact can vary considerably from each insurance circumstances. So along those lines, in order to kind of help finalize this, we felt some of these questions would be helpful for us in being able to kind of pull together the framework that some of this has been discussed earlier, is how does the International Capital Standard fit within other issues that will be done from a supervisory standpoint. So some of the considerations are, first, comparability. If you're comparing averages, is a very different question than trying to compare tail events. You can get a fair amount of comfort that the reliability of comparing averages is going to give you some meaningful measures, which is typically what the accounting perspective has been. If we're looking at a solvency perspective, we're really trying to understand how vulnerable is this organization to extreme events, which have much less precision around them. Are we looking for risk sensitivity for today or over the long term? Is the objective to be run off the obligations? Is it to keep it as a going concern? And how do we think about the implications for a viable market? Each regulatory jurisdiction may have different preferences on that. It's not that one of these is right or wrong, but does the framework allow those jurisdictions that may have different preferences to see how their framework fits into the larger ICS framework? When we talk about supervisory intervention or consequences, what are those specifically? what legal authorities are being triggered, and what kind of regulatory triggers are occurring as well within the supervisory college. And then this idea of, are we trying to do a valuation that is looking for shareholder perspective or from the solvency perspective, and what are the implications? Because then it allows you to think about what are the consequences of numbers that get reported and how does it get harmonized with other tools. So obviously groups have multiple supervisors and regulators, and as I've mentioned, they may have different objectives, approaches, and risk tolerances. So just as a couple of examples, the U.S. is known as having a bottom-up approach to regulation, where you regulate the legal entities, and as you roll up, you assume that that means the group is solvent. Europe has said, no, we think it's important to have a top-down and start with the top-down and then go down. It's not that one is right or wrong, but let's make sure we understand the implications. What is the objective of solvency? Is it to save the group? Is it to save legal entities? Or is it to save the market? And what does that mean, and how do I interpret the number that I've calculated and what it means for each of those audiences? So we want to make sure that there's a coherent way that these things are kind of put together. So once you have defined the numbers that you're looking for, or you define the framework you're going to use, it's important to recognize that this is really, to me, and to the actuaries, we've really started to realize this is such an interesting, fascinating question, because historically capital was looked at as legal entity. And it's a new question to bring in, what does it mean for a group? What is it? Certainly groups often have greater access to capital, but maybe the capital is not fungible where it sits. And intriguingly enough, what is the head of the insurance group? And we feel this has actually been a topic that's starting to be better understood, that it's not just a case of saying, am I affiliated with someone, but where's the influence exerted? Who is it that exerts influence within the organization, and how do I define where the group starts or stops? Once I do that, then you basically have a set of tools that you can use when the stressful tail events occur, and how would you address them? And so the measurements that are being used would be helpful to tie them into indicators or triggers for some of these different issues. It may just be support from external suppliers. It may be the use of options within the group, intergroup loans, internal reinsurance, selling off of assets or business lines that exist within the group, being able to address how do I think about fungibility and how flexible is that? Can I change a legal entity structure? What kinds of funding recovery is available within the country, or what kind of funding recoveries exist across country lines? How could I strengthen capital position? So oftentimes for short-term insurance, when there's a change in the market, there may be a stressful event, but I raise my capital through the fact that there becomes a hard market, and I raise it through selling business the next year. That's the way that I raise my capital. If I'm in a long-term business and have made into obligations that are hard to deal with, then capital has to be raised from a different kind of source. So with that, that's our general overview. We have more specific details that we'll share later.
Thanks very much, Dave, and thanks to the three presentations from the three organisations. Our plan was now to have a session of questions from IAIS members to yourselves on any of the material that you've raised. We certainly have a number of EXCO and FSTC members around the table, so we'd encourage any of those members that have questions to you to put them forward, or any other IAIS members in the audience, and then we'll turn to if any other stakeholders wish to ask you questions or make related comments before we move on to the general question and answer session. So could I look around the table and see if there is a member that would like to start the process of putting questions to our three stakeholders' presentations this morning?
So I'll start, and I have a question for you, George. When you were talking about the discounting options, various discounting options, I thought I heard you sort of caution about sort of combining sort of salient characteristics of different models and bringing them together. What is your concern in that regard in terms of selecting various features and combining them to a sort of a comprehensive discounting approach?
Thanks for the question, Elise. As I understand it, the primary concern is that as you start to adjust the different valuation discounting rates, you're actually ignoring the interplay of different aspects outside of those measures. And so there are other things that triggers as you apply the different rates, then that causes other things to happen, and you end up with essentially either masking or ignoring some of these interplays. So our recommendation is that you stick to more fundamental approaches and see how they play out and see what the results look like. And then as you see that where you land with that, then to start to address, it might be through qualitative measures, some of the ways to get to the desired supervisory objective. And I will say, I don't know, you know, at the risk of offending the process here, but you know, as we've described, we have secured the agreement of majority of our members on some approaches. We've got consensus views on some of the fundamental questions here, but I'm sure that some of my members or our members are behind us and around the room are happy to contribute at the will of the chair for them to intervene at any given time.
Just follow-up question, or it does not have to be George, but it's related to George's presentation. You mentioned that we should not close the option. It's a valuation issue. We should not close the option, but everybody knows here that we would like to achieve convergence, and within the time framework that Vicky clearly mentioned. So if you are stakeholders, if you are us, what do you propose? So, of course, we understand the options, but of course, you understand and everybody understands that we need to converge. So what's your proposal? Do you have any clear idea? How do you achieve, from your view, to us, how do we achieve convergence within the very tight time schedule? Thanks.
If I can add to this one as well, just to reiterate the message. When you talked about options evaluation, you highlighted 3 options, and so 2 of them are the 2 extreme. One at the bottom of your presentation is risk-free rate, and at the top of your thing was on assets with guardrail or asset earning rate. These are completely different, and in between you put a reference portfolio. And you said some member or the majority supports this one, some other this one, and some other the other one. How do you plan to reconcile the views of your members with respect to that? Because there are fundamental differences between your members.
So that's a question that I'll put my career on the line and try to answer. I think that's the point. The point is that there are a wide range of views, and so we continue to support you examining a wide range of options because we're not yet there, and I suspect that, you know, you guys are having a similar problem of finding the happy median or something workable. It doesn't necessarily have to be in the middle either, but that it has the features that you're looking for to achieve your objectives. That's the other reason we refer back to supervisory objectives, to be clear that as you're evaluating the results of the field testing, that you're making sure that you're still meeting agreed objectives. You know, one of the things that also seems clear is that at some point, early in the process, you're having to be inclusive of different systems, and that may end up being a feature of your end result, or at least the result that you build and put more into the, you know, into actual reporting. So I think what we're saying is that we're not having a much easier time than you are in finding that middle ground, but we do have specific proposals that we're able to present to you. And, you know, I think as you've seen, there are groups of our members that are willing to discuss those with you in further detail. But fundamentally, we support the continuing to look at a range of options because we're clearly not there yet.
Paolo, I'll kind of expand on a little. Some of this I was going to cover a little bit later in the second set of slides, but building off of the question on valuations, what we've concluded or realized is that the discounting or valuation question has to be integrated with other pieces. And so the idea of it's certainly possible to say, let's use a risk-free framework, and it will give you an answer, but it will have some imperfections and shortcomings. And ironically, or actually in a positive way, some of those shortcomings will be addressed by the other methods. So if I actually have a methodology that's looking at 2 or 3 different valuation streams, not that are tweaking each other, but that are kind of coming from a fundamentally different perspective. If I'm looking from a market value basis versus a real world basis, I want to be able to understand how do my cash flows actually occur in the real world is a very useful and important question, particularly for things like fungibility. On the other hand, if I'm looking at the actual economic cost in the market, that's also useful information for other questions. So I would hope that you would come to understand it's not a question of one number is more correct or a better number than another. The choice that you make will give you some good information, but it will have some holes in it. And that's why the IAA has been focused on saying, given, if we can, once we kind of get a little more substance around those and could say, here's this approach, here's the linkages occur, and let's say here are the holes with it, here's how it can be addressed through some other methods. It may be through a valuation method, it may be through some other process as well.
Another follow-up question to all of you, which is more about, you had these 3 options, and do you find a clear divide between the type of firms? For example, you have non-life firms, which for them probably discounting is less relevant, and they prefer to have something or an approach to discounting which is simpler, whereas, of course, for life firms becomes more relevant and they strive for complexity. You have, to a certain extent, a discussion between these 2 firms which sits at the 2 opposite front. I mean, do you have any solution for that?
Well, so take the issue of discounting. I mean, for example, on the PNC side, if an actuary is saying, we would rather not do discounting, we'd rather just hold the cash as the reserve and the liability, I can't imagine as a supervisor you would be disappointed with that approach. And I think their point has been the complexity of doing the discounting and the cost is not really relevant. It doesn't make a material difference on the number. And obviously, if they feel satisfied that by reporting the actual expected cash flows, I mean, it'd be in their best interest to find a way to lower that number if that was really the issue. So I think that part of it is an issue to me that hasn't seemed as important. And at the same time, being able to understand the value of future cash flows is very relevant for longer-term business. So I think I think it's a solvable problem. I think it's an appropriate question, and it's been a point of discussion. But as you start to craft each specific valuation piece, I think you'll be able to say, oh, okay, here's how this piece fits in. And if someone chooses not to discount, I don't think anyone's going to argue with that. Are there any other questions from members around the table before we invite stakeholders to join this part of the conversation?
It's actually a question that all of you could answer. I mean, you talked about better integration of ICS into ComFrame, and just building on some of the comments that you made, Dave, about looking at different numbers. I mean, ComFrame already includes the ORSA, for instance, and that has a number of different measures within it. Do you have any suggestions for us about how we can look at the ICS and the ORSA together in a supervisory college context?
Well, I would also add ICPs dealing with recovery and as well, because what you're really trying to say is, can we create a conversation that says, given that this scenario possibility occurs, how are we equipped, either as a company and as a regulator? And that's why I put up the picture with the clouds in it, to say, these are options in a sense.
all companies have these options intrinsically. As you start to hit triggers or require regulatory intervention, you're really trying to say the regulator needs to be able to come in and have some influence on some of these bubbles as well. And given any number we use will be imprecise, but we want it to kind of be a wake-up call that says, hey, attention is needed, and we should be having a discussion, particularly in insurance. We typically have time to have resolution. And so it's really a question of how do we start coordinating that so that we can either ensure the survivability or ensure that the appropriate people are being paid off and manage ourselves through the crisis. If we do that ahead of time, we'll be much more able to process it. So I think, I mean, to me, your point is exactly correct, that it's the combination of ORSA and numbers that creates a dialogue, both from the company to the supervisor, but across supervisors as well, so that no one's surprised in the moment of crisis, all of a sudden locking everything down because I don't know anything and all I need to do is to hang on, because you want to say, oh no, we know exactly how to proceed. We've already talked through this and this will be an effective way to go. I mean, think about just a contrast between the Great Depression and the crisis in 2008. The financial markets in the Depression took 10 years to recover from the effects of a crisis. And partly, I mean, while it was not, it certainly was a dramatic and significant event, from an economic standpoint, most countries felt like they had thought through the kinds of tools that they needed, so that we had recessions and we had issues that developed, but we didn't end to a 10-year kind of global depression, which I think was a real possibility. But that same way of thinking about this process is what I think the opportunity is for the ICS.
So we'll now invite any other stakeholders who would like to ask a question of these related to these presentations or make a comment about it. Then we'll open more generally. So, Christine, if you'd like to ask something that's related, just please and identify yourself when you come to the microphone, please.
I certainly hope somebody salvages George's career. I think he did okay. But
Thank you, John. Hello, everybody. Christina Mihai from Insurance Europe. I was not planning to start with valuation, but maybe it's better to start like this because this was the last point that we discussed. And as you know, the Insurance Europe supports the market-adjusted valuation in the ICS. We support assets valued at market values, and we also support liabilities valued in a way that we can reflect the asset liability management. Very concretely, and we also, very importantly, we support the IAIS objective of minimizing balance sheet volatility, which we would call artificial balance sheet volatility, because we want to avoid any volatility that is given by the measurement and not by the way in which companies actually manage assets and liabilities in practice. So concretely, in ICS 1.0, we support at least 2 valuation alternatives to continue to be tested. The first one, and it's not an order of importance, is one based on spreads on actual asset returns of a firm, and this should also include the option for hypothecation to liability buckets that is specific to a firm. And the second option that we support is one based on a representative portfolio, which can be representative for currency or for a jurisdiction, and takes into account the spreads or the yields earned of the assets in that representative portfolio. And maybe just to answer a bit the question that was raised earlier, how can we ensure comparability given that we want to continue testing multiple options? And I think one example that was given was the fact that some companies want to test the discounting based on risk-free. Well, this doesn't mean that we will not have comparability, because if we think, for example, at discounting at risk-free, we will always have liabilities that are higher than liabilities measured at this risk-free plus something else. So from a supervisory perspective, this, if anything, should be a pleasure, not a concern. But this doesn't mean that we should prevent other companies to value their liabilities as they should value them and as it is best to reflect the asset liability management, because there are various types of asset liability management and companies should be allowed to do this. It's a bit like saying for real estate we have a 30% capital charge, but some companies could afford a 100% capital charge, so we should impose to everyone a 100% capital charge. Well, not really, if 100% doesn't really reflect the risk of holding real estate on our books. So, and then I would just give the European example. In Europe, we have two valuation approaches, and they work very well together, and they ensure comparability. And as you know, we have a framework in Europe that ensures harmonization and full comparability across companies. And why? Because in practice, the methods are defined in such a way that they match each company's practice and the way in which they do business. So at the end of the day, those companies who manage their business in a similar way, they will achieve similar results. So this on valuation, and maybe very important for us, and it's something that we learned from Solvency II, is the fact that we need very good testing of valuation approaches, because in Solvency II, for example, we realized that we hadn't tested enough just before finalization cases of extreme market scenarios and, of course, the crisis period. So we are very keen to see a very good testing of valuation methodology also in periods of market turmoil. So this on valuation. Then going back to more high-level comments from Insurance Europe very briefly, we also have a concern on timeline. We believe that it is very ambitious, that it is currently set. However, we understand that we stick to the current timeline. I guess the key message for us is that the ambition of the timeline should not sacrifice an appropriate design, an appropriate calibration, and appropriate testing of the framework. And as long as we ensure that we have the right design, calibration, and testing, then I guess we need to do our best to work within the set timelines. Then another point, which some may think that is not necessarily appropriate for this audience, but we would still make it because we do make it in Europe with the European Commission, for example. We believe that a global standard can only achieve its aim if it's implemented consistently across the world. And of course, that from this forum, we have a commitment for development of a standard, which is in the IAIS mission, but probably we remain concerned about implementation. We understand the commitment by supervisors to encourage their jurisdictions to implement. However, this is not necessarily a commitment for implementation. So, especially from a European perspective, we would be very concerned if we reach a standard, first of all, that is not fit for purpose, but assuming that we have the right standard in place, we'd be very much concerned of having worked so much and then reaching a stage where we do not have consistent implementation. So we basically do not achieve the aim of the framework itself. And last but not least, maybe a comment on the capital requirements calibration. As you know, for us, one of the key concerns remains the lack of inclusion of internal models in the ICS. We very much hope that internal models will be considered and discussed in ICS 2.0. I think we can all agree that a perfect standard, a method that fully and appropriately reflects the risk of each and every company is, let's say, impossible. And we definitely learned this in Europe. And the alternative to that would be a very complex standard method, which probably many agree that is not necessarily something that we would like to have. So as a consequence, we believe that internal models need to be defined as an alternative to the standard formula with, of course, appropriate criteria and parameters in place. But we would like to see this discussion started as soon as possible and then included in the field testing so that we can already get the experience of internal models in the field testing exercise. I would stop here for now. Thank you.
Thanks very much, Christina. And I think we have Dan Rabinowitz, but I'll let you introduce yourself, Dan.
Good morning. Thank you, John. I'm Dan Rabinowitz from AIG. I wanted to speak very briefly to amplify one of the points which did get some questions from the panel, George's point on the primary colors approach to consideration of field testing of options on valuation. We are part of the working group which originally tendered the own assets with guardrails option into the discourse. That's a working group which includes my own company, AIG, AIA, Allianz, Aviva, and Manulife. We even let Manulife in, although their company name doesn't begin with an A. We are also active working members of the much broader IIF-GA coalition, which has been working on and considering these. And I think that as was correctly stated this morning by the GA and IIF members, there is a very broad consensus that this is an option which is worth field testing. The observation that I would like to make is about the primary colors theory. We all believe that quantitative assessment and that the value of field testing is to deliver thoughtful, longitudinal, comparable data sets which we can all use to make assessments about what the wisest course to follow on valuation issues might be. I think our sense in advancing the primary colors theory is that it is important for all of us to defer the process of technical and political compromise in these matters until such compromises can be wisely approached on the basis of a full and rich longitudinal data set from industry. As Dave Sandberg correctly pointed out this morning, these compromises are not simply political. They represent a weighing of different, entirely legitimate, competing prudential supervision objectives and different, entirely legitimate, serious considerations about the way, from industry's perspective, that we carry out our business and serve our policyholders' interests. I think our view is that it would be wise to defer compromise in terms of slicing and dicing among the proposed field testing modalities until such time as we have a richer data set of quantitative assessment, the kind of data set that a field test of definably different primary colors approaches will bring. And at that point, both industry and supervisors will be in a better position to weigh the entirely legitimate but necessarily competing objectives along the path towards a globally convergent group capital standard. So that's what was meant by our suggestion that primary colors are a good way to think about how to frame different alternatives for field testing. We think that in the end is going to yield a richer and more valuable data set for decision, both on the part of the supervisory community and the IAIS, and on the part of industry as well.
Thank you very much, Dan. Good morning. Please introduce yourself.
Hi, I'm Elisa Delgova from the Association of British Insurers, but now I'll be speaking on behalf of the Global Federation of Insurance Associations, GIFIA. So GIFIA represents 41 trade associations from across the world, which together account for 87% of total premiums worldwide. And so the depth and the breadth and diversity of our membership gives GIFIA a unique perspective on the ICS, as well as maybe a degree of insight into the types of challenges that the IAIS might face in developing global consensus on these issues. Having said that, there is a lot that we can, as industry, agree on, and we have submitted a GIFIA response to the ICS consultation, answering a range of both high-level and technical questions. So I just wanted to highlight some of the key messages from the Global Federation. And the first one is going to be echoing some of the comments that previous speakers have made around the timelines. The ICS is the single most important development in international prudential regulation, and I think both the industry and the supervisory community have a joint interest in making sure that the final outcome is sound and appropriate. And at this stage, I think there are both technical and conceptual issues that still need to be addressed before the ICS can be a fully developed final product. On the technical side, which is where most of the focus has been, there has been really impressive progress made. Having said that, we would encourage the IAIS to continue exploring options on valuation in particular to ensure that the ICS accurately reflects the nature of insurance products, particularly those that are long-term in nature. Apart from technical issues aside, there are also important conceptual and implementational issues that still need to be thought through before an overall assessment of the ICS can be made. And, you know, for example, and this is an one that has already been cited by previous speakers as well, it's still not clear what the relationship between the ICS and local prudential regimes will be. I understand that the IAIS views that the ICS is a global standard and so will not impact on legal entities and the prudential regimes locally. However, in practice, unless further thought is given to the relationship between the global and the local regimes, there is a risk of inadvertent overlap in purpose and coverage. So we would encourage the IAIS to consult with stakeholders on these fundamental questions of ICS purpose and design, including the supervisory consequences, if any, of the ICS once implemented, which is a point that, Victoria, you have raised in your comments. So just to summarize, I think it's because there are still technical and conceptual questions outstanding, these need to be addressed first. And I understand that so either the timelines or the level of ambition needs to change. So I understand that EXCO has considered the issue of timelines, and these are set, which means that the question then arises: how do you make sure that you are still able to deliver something within the existing timelines, which brings to my final point. The Global Federation has had a long-standing position, and it's one that we can agree on, that local regimes that are consistent with the ICS framework should be considered as a practical implementation of the ICS, and we think such an approach would allow the IAIS to move to convergence over time while still having the flexibility to be able to achieve this in practice. Thanks a lot.
Thanks very much, Alicia. You, Francis?
Thanks, John. I just wanted to try and capture a few my observations.
Sorry, I know most people know you, but can you just state your affiliation for the record?
With Aviva, based in the UK. I just want to capture a few of the observations and questions that John, Paolo and Yoshi made a bit together. I think, Yoshi, you asked the question, well, how do you achieve convergence? I think one of my observations, and we've been heavily involved in the field testing throughout, is even from the results that we saw in 2016 under the IAIS analysis, we have a situation where we basically have two different measurement bases. And within those measurement bases, I think the figures quoted in the field testing results was about 80% of that difference is due to discount rate. So there clearly, if you're going to look at where are you going to find a solution to try and get the results more comparable, discount rate is clearly the area to look at. And I think that's also important because I think there's an oversimplification of what the alternatives between a gap with a adjustments approach and MAV. You know, if you're looking from MAV to gap with adjustments, well, it's not risk sensitive and doesn't move very much. If you're looking from basically gap over to MAV, you're saying, well, this is ridiculously volatile and pro-cyclical. So, you know, that's an oversimplification, but that's the different camps. So to my mind, clearly the area that you'd look to in terms of trying to achieve more comparability of the results is the discount rate. And I think that links with the comments that both George and Dennis made in terms of reflecting the business model. And for us, ALM and others are a key aspect of that. The linkages between asset and liability and how we manage this business is a key aspect of that. And within that, I think Peter, you asked a question about, well, how does ComFrame link with that? Now, you know, one of the options that we're part of the group that's looking at own assets with guardrails, and of course that group in terms of convergence represents companies operating in each of our significant jurisdictions who have been trying to look at the same issue on convergence. And our observation would be, often the comment is, well, what are the guardrails? Well, actually, there are elements of ComFrame that clearly, on a qualitative side, could be developed and enhanced that would actually provide many of those guardrails in terms of principles for investment, how you manage ALM, how you look at risk management, how you do those sensitivities. So that's why we think that both the ComFrame and ICS need to develop in parallel, because there is a crossover between the two. Paolo, you asked the question about P&C. Well, we know that within the 80% difference on valuation, that valuation is most seen in terms of the challenge on procyclicality, in terms of the long-term business. So clearly, you know, to me, I think most of the issues we've experienced are on the life side rather than the non-life side. But clearly within that, that's why we're very much asking that we put alternative approaches on the table to be tested in an unadulterated way. The reason we say that is that our observation from looking at some of the discussions we've had in the field testing results concepts is there seems to be a slightly mismatched. Let's look at the 4 options, and we could take a little bit of this option and apply this application ratio, or we could do this or this, and that will get us to a result around this. Well, from our perspective, we should be standing back and looking at, well, overall, what are the results under the different alternatives that help to address the challenge of convergence. So that's really why we're strongly saying that a range of options must be tested and should continue to be pursued in relation to into the discount rate. For us, the own assets with guardrail is a key one of those. But I think generically it would make sense, because this is such a sensitive and a political topic, that we give enough time to that. So if you go through a basis, as you've proposed, that you have, what we're not going to call version 1, but the extended field testing type option, that you keep some of these other options on the table, because I think they will inform the discussion and really help us to shape what the alternatives, but in a objective, quantitative way, that we can do that in an undulated form without addressing some of the wider political issues. So that's kind of, in summary, how I try and address a number of the points that you've made through the ICS testing.
Can I ask a question? You can stay there. I mean, it came quite a lot today in terms of number of options and so on. People will have to appreciate there is a trade-off between the number of options and the quality of data we receive. And the burden we impose to firms, there are some firms which we will go to a great extent and please us and try to submit 10 options, but effectively the data quality suffers quite a lot. So we need to be conscientious, as you'll see later on in our presentation, with respect to the number of options that we put to field testing. This is quite important, because you can have 10 options, but effectively some of them are exactly the same results replicated by the firm 10 times. And that doesn't look to us as a good data quality. So there is people need to appreciate the trade-off. There are different, again here, firms that would like to go to a greater extent to accommodate requests. But last year, we started with lots of options, and firms started complaining that too many options were subject to field testing, because it's not only the number of options, but is, as people pointed out before, is for each option there are 2 calculations to be done, one under the normal scenario, one under stress, and both are important to us, because so it is very easy, and it would be very easy for us to say, let's go and test it as many things as options are. But then we have data all over the shop.
Your response to that, Paolo, would be, you've got generic responses from GAIF that's saying the options currently on the table that were tested last year do not meet what we think would be an appropriate basis. And from our perspective as field testing companies, we are exerting a considerable amount of internal resource at a time when we've got lots of competing commitments to voluntarily participate in the ICS field testing. So for our perspective, for us to continue that commitment, particularly given the lack of certainty about the political implementation sense, within those options, we'd at least expect to be testing the ones that we think would actually address the issues that we think you're trying to in terms of stability and pro-cyclicality. So, you know, doing marginal difference, do we do X% or Y% of this ratio, is not quite the point. If we could got more fundamental issues about, well, we think if you do this approach, it will actually help convergence. So I'm not asking for multiple 10, 15 different options, but even with what you've heard from the IFGA and also from Insurance Europe, there is at least, you know, 3 or 4 key ones that we think it's important to get on the table and keep on the table.
I think we get back to the discussion once we present what we are proposing. I think we'll make our life easy.
Liz, could you introduce yourself, please?
Hi, thank you. Yes, Liz Dietrich from Prudential US. I'm going to build on a couple of comments that have been made already. Primarily the point around recognizing the ICS as a part of the broader ComFrame framework and the importance of having that recognition within the ICS as well. And what I mean by that is, I think you've heard before me and other stakeholders say that the ICS is a very useful tool, but it is not a supervisory silver bullet. Capital is not the answer to every supervisory concern, nor should it be. And one of the ways that we see this opportunity to have a better, clearer recognition of the elements of ComFrame within the ICS is within valuation. So in the past 3 years or so of field testing, participating in that exercise and having the dialogue around valuation, one of the common themes is prudential concerns around what could happen if companies are able to reflect, frankly, a spread that reflects the way that they invest in valuing the liabilities on the ICS balance sheet. Concerns about not being able to achieve that spread over time, concerns about perhaps incentivizing inappropriate investment behavior, among other things. And we see ComFrame we see the ICS as part of ComFrame, where ComFrame provides a lot of the mechanisms to answer those questions and provide that comfort that insurance companies are behaving appropriately with respect to their investment behavior, their asset liability management, such that the discount rate needn't be the way to control for that. And in fact, trying to control for those concerns within a discount rate is not the most effective or appropriate tool, and in fact can be highly ineffective and highly inappropriate in the sense that it provides misinformation. So we think it's important to have a linkage between assets and liabilities, to reflect that linkage between assets and liabilities within the solvency balance sheet, and doing so through a discount rate that reflects the way the insurance company invests. We think if you have an own assets with appropriately defined guardrails or an appropriately defined reference portfolio to define that discount rate, that both of those are going to be linked to how the company invests. And if you divorce assets and liabilities and apply conservatism to address other supervisory concerns within the discount rate, you're creating an inherent mismatch between assets and liabilities, which will translate into volatility and pro-cyclicality on the balance sheet in capital resources. The other issue is the fact that that inherent mismatch between assets and liabilities then exacerbates the impact of stresses that you perform to determine capital requirements and any MOCHI provision that you may have to hold on that balance sheet. So there are second-order effects. Then there are the effects on the business model. So this is, you heard Dave say, the discount rate is really important for life insurance companies for long-term liabilities. So any inappropriate divorcing of ALM of assets and liabilities in the discount rate in the ICS could have the impact of deterring companies from providing that long-term protection and retirement type of insurance products to the market, and the associated long-term capital investment that they currently perform to support those liabilities. So we think it's really, really important that the aims of supervisors are met, but that we can look beyond just the capital framework and beyond just the discount rate to address those supervisory concerns, so that we don't create an ICS that is misinforming and misleading to supervisors and other stakeholders, and also that doesn't have these adverse unintended consequences on our business models.
Thanks very much, Liz. Patricia?
Thanks. Patricia Plath from AXA. I just wanted to come back on the reason why we supported the idea of multiple options. As mentioned by Dan, we work in many trade bodies, and as ICS is a global project, we essentially worked also where we are coming together with other firms from other jurisdictions. We are a European group, and because of that, we started Solvency II 1st of January 2016. If you remember, most of you also participated to those discussions. The discount rate and the counter-cyclical have taken a long time before being on the table. There is not only one solution on counter-cyclicality within Solvency II, and the fact that there is no one solution is depending on the characteristic of the liabilities. We do not want to lose, in fact, all the work which entered into Solvency II. So we consider that the options which are within that framework should be part of the current discussion. However, being part of those global discussions, we also understand that for other groups, other alternatives needs to be tested. And that's part, I think, of the convergence work. And that's the reason why we welcome what we just heard about the extended field test period. We believe that this will certainly help towards convergence. We have also supported the fact that a reassessment of the timeline of this project is needed. And also in that context, I think that we would welcome this re-situation of the ICS into the more global context of ComFrame. We strongly support, in fact, the qualitative elements of this framework. Also, the qualitative elements which have been a step in the GSI framework. But we strongly believe that for the quantitative part, more time will be needed.
Thank you very much, Patricia. There is a little bit of time if Michelle would like to join us, or somebody else. Welcome, Michelle.
Thank you very much. Michelle Rogers with the National Association of Mutual Insurance Companies in the United States. Since we were invited as stakeholders to make presentations here at this important meeting, I felt that it would be a good time to talk about how many of the associations that interact with this organization have very diverse interest groups that they also work with. As several of the international organizations who have spoken in the past or earlier today have indicated, there is a need to coordinate with a variety of countries, a variety of interests within the industry, sizes of companies, as well as lines of insurance in the National Association of Mutual Insurance Companies. We have nearly 1,400 members of our organization. The large majority of them are mutual. Many of them are very small, but we have also the very largest insurance companies, or many of the very largest insurance companies that are also multi-line in the US and in the world. We also represent some stock and reciprocal companies that are internationally engaged, and we have additional members every day on a monthly basis. I'm hearing about more and more involvement of our medium-sized and small members in the international arena. So our perspective is one that needs to look at all of these varying issues. And so the issues that I bring to your attention involve concerns about disproportionate burdens of the rules and the formulas that we derive as far as the small companies are concerned. And while we talk about this as only applicable to the IAIS, in the US and in other countries around the world, most of the discussion seems to be evolving around a change in the capital requirement, not just for the IAIGs. It seems to be something that's being imposed on companies throughout many of the regimes. So we need to look at this and how it affects all of the companies. I also raise with you any impacts that would show that how it negatively impacts the property casualty industry. As Dave Sandberg has mentioned today and others have noted, the property casualty industry has a very different business model than the life insurance industry. The risks of long-term involvement, of long-term liabilities are more limited. There is an immaterial impact on financial stability that most have recognized in the property casualty industry. So to put property casualty insurers through the same steps for achieving an international capital standard that you put the life industry through doesn't always make sense. So there need to be some considerations for the differences for the property casualty industry to avoid a costly and yet immaterial impact on financial stability. And finally, I think that the idea of creating a standard that would require a massive and expensive overhaul of the US system of state regulation, of corporate organization, of our accounting and valuation system, of our capital-based resources and our capital structure, at the end of the day, is unlikely to be adopted in the United States. We need to come up with something, as many have said, that is a lot more inclusive and inclusive of different ways of evaluating. Look at the ICS as a tool that can help regulators, especially in the supervisory college context, to identify problems with companies and go back to their local regulators and let them evaluate those problems based upon those concepts. For the mutual interests in particular, this is critical. You are probably all aware that in the United States, the Federal Reserve and the NAIC are both working toward identifying group capital calculations that would look at how we can create some kind of a group capital assessment within the United States. And both of these situations, they are evaluating an aggregated standard, a bottom-up approach as opposed to a top-down consolidated approach. And the reason for that is largely because of the mutual insurance industry. We are significant in the United States. We represent 39% of the insurance premium in the overall property casualty industry. We represent 54% of the homeowners insurance premium and 34% of the business insurance premium in the United States. Any standard in the United States that would not take into account the needs of the mutual industry that do not produce, on a general basis, they do not produce a GAAP financial statement. So they do not have a consolidated set of accounting standards. The only way for this to occur without massive changes to our accounting requirements in our system is to do this on an aggregated basis, and that is why one of the major reasons that this has been accomplished in this way or is being pursued as an aggregated approach. And I think that it would be advisable for this organization to at least consider an inclusive approach that would look at either a bottom-up or top-down and not be looking at an aggregated approach as too simplistic or too that wouldn't incorporate all of the relevant needs to reach a very similar conclusion as a top-down approach. The rationale behind that is, at least where we are going within the U.S., is not so simplistic. We are looking at making or avoiding appropriate duplications, eliminating unnecessary capital that might appear within different organizations, within the affiliated organizations. And so it seems as though that if we do it correctly, there should be an immaterial difference between the consolidated, the bottom-up approach versus the top-down approach. And so it's something to give a lot of attention to before we just dismiss it out of hand. Also, as we speak about mutuals in particular, they are only applying their capital, as I indicated, on a regulatory accounting basis. And something that has really confounded me throughout this entire process is why this organization of regulators, of supervisors around the world, is looking at creating a evaluation system that won't recognize necessarily a regulatory accounting system that is intended to be more conservative, is intended to be there for the purposes of protecting policyholders and providing policyholder protection as opposed to investors. And I think this was mentioned by one of the earlier commenters as well. We think that it should be very clear, and in both ICS 1.0 and 2.0, that the regulatory accounting system, at least ours in the US is called statutory accounting, be allowed as a form of GAAP on a adjusted basis to be included within the systems that are allowed. And then finally, I'm going to touch on capital resources as one of the cornerstone issues and one of the cornerstone problems that we have with the ICS and the direction it is going. We look at the problems with the exclusion of surplus notes, senior debt, and other subordinated debt as seriously problematic for the United States. We're concerned about a tiering concept within capital resources that is really based upon a banking model, not based upon an insurance model. We look at capital as capital within the US, and it should be accounted for equally, and that doesn't seem to have caused problems with the solvency system in the United States. So I would encourage you to be open to that idea and at least including the option of including other forms of capital. In our thoughts and in our remarks and consistently in our comment letters, we attempt to help identify unintended consequences of this ICS. We are seeking to achieve a more inclusive global standard and not one that is dangerously exclusive. So we want to assure that the IAIS is not wasting a lot of money and time on issues that are immaterial to the overall financial stability and immaterial to the overall protection of policyholders, which is really the reason we're all here. If these key issues cannot be addressed, NAMIC cannot support adoption of the ICS in the United States. And we will make every effort and take every action possible within our state legislatures, within the NAIC, and within our federal government to make sure that that doesn't occur. Because the cost of imposing a system that is completely unfamiliar to the United States would just really upend our insurance industry in a way that would make it non-competitive with the world. The cost is just much too great, and so without these costs without these changes, the cost to our members or the regulatory system just cannot occur. I think the IAIS has a chance to reach some agreement and to find some inclusive common ground where we can look at differences in systems and not worry about absolute perfection on a comparability. And I think it's time to try. And I thank you for the opportunity to speak here. And I hope that I'll be happy to answer any questions.
Can I ask a question, Michelle? I mean, you mentioned, if I understood correctly, that you got, within NAMIC, you got 3,000 members.
1,400.
1,400, sorry. How many of these 1,400 are international active, or how many of these members are internationally active insurance groups?
We probably have about, this is a number that is hard to calculate at times because we know we are finding out every day about more and more of our members that are engaging in reinsurance operations in Europe, as well as being regional writers within the United States. We know of a few of the very largest companies that are internationally active, and that would include Jeff, CNA, who's at the table here, Chubb. It includes also Liberty Mutual, State Farm, who has some interest in other countries. We have American Family, we have USAA. All of these companies are involved on an international basis around the world. They're large writers. Some of them are looking, some of our largest writers are looking to engage more on an international basis. Some of them, some of the medium-sized writers are getting involved. We have small companies that are assuming reinsurance from European or European countries. So, you know, that's what I said, that the number is not, we haven't gone out and asked every single member for a counting of how many countries they're involved in.
Thanks very much, Michelle. Jeff, welcome. We are running right up to a coffee break. We always love to hear from you. If you would like to speak a little bit before coffee break, that's fine. If you'd like to reserve your option to be one of the first ones in the next session, that's also fine. It's up to you, Jeff.
Yeah, no, I don't want to hold anybody away from coffee, so I mean, I'm not opposed to waiting. But my comments are more general in nature, and so I'll just go after the break. So I appreciate it. Thank you. Do you want me to go now, or you want me to wait?
Well, if you can make some brief general comments now, then we'll go straight to coffee. If you want to hold them, there's more chance of perhaps promoting a discussion if you hold them.
Yeah, that's a fair point. I'll wait.
Thank you. So it's coffee break time. Please return at 11 and we'll get into the second session. Thanks, everybody.